a UK investor's guide to global equities, tax-exempt gold, and ISA architecture. Flint West reporting. Here's the problem. If your currency is losing purchasing power at 7, 8, 9% a year, and your money is sitting in cash, you're not saving, you're losing. Slowly, quietly, predictably. And if you move that cash into a fixed domestic bond, thinking you've solved the problem, you haven't. Because the bond promises to give you your pounds back. It does not promise to give you your purchasing power back. That distinction is everything. If the underlying currency is being debased at 7 to 9% year over year, then a fixed nominal return can look perfectly respectable on a statement, while producing a negative real return in the world that actually matters. So the question for the investor becomes very simple. Where does the purchasing power go? Because it doesn't just disappear. And this is where the conversation gets interesting. Section 1. The Great Wealth Transfer. An economy's output can broadly be divided between two buckets: labor and capital, wages on one side, corporate profits on the other. And over the past 30 years, labor's share of the economic pie has fallen toward historic lows, while corporate profits as a percentage of GDP have doubled. Now think about the mechanics of currency devaluation. A corporation can change the price of its product tomorrow morning, sometimes literally overnight. Food, software, energy, insurance, subscriptions, consumer goods. Prices can move daily, weekly, monthly. But your salary? That might get reviewed once a year, maybe. So you have an extraordinary asymmetry. The selling price adjusts quickly. The wage bill adjusts slowly. And that lag matters. Because if a company raises prices by 9% while wages rise by 4%, the company has effectively reduced its labor costs in real terms. The employee still receives more pounds, but those pounds buy less. Meanwhile, the corporation has repriced its output into the new monetary reality. That purchasing power has effectively migrated from the labor bucket into the capital bucket, which means if you spend your entire economic life standing exclusively on the labor side of that equation, you are standing on the wrong side of the transfer. The obvious response is not to stop working. It is to become an owner. Section 2. But then the government steps in. And now we arrive at the second problem. Suppose the currency loses 9% of its purchasing power. You buy an asset. The asset rises 10%. Nominally, you made 10%. In real purchasing power terms, you barely moved. But capital gains tax does not necessarily care about that distinction. The government sees the nominal gain. The currency falls. The asset reprices, and the state taxes the repricing as though you became substantially richer. That is the nominal illusion. You can effectively end up paying tax on what is, economically, little more than the preservation of your original purchasing power. In other words, the currency gets debased once. Then, the nominal gain created by that debasement can be taxed again, which is why the architecture surrounding the asset becomes almost as important as the asset itself. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3. Why corporate pricing power keeps working. Now there is an obvious objection here. If wages keep falling behind prices, eventually consumers run out of money. Correct. But modern economies have developed several mechanisms that keep the machine running. The first is credit expansion. The consumer cannot afford the higher price from current wages, so the financial system bridges the difference using future wages. Credit cards, consumer loans, buy now, pay later. Debt becomes the bridge between stagnant purchasing power and rising nominal prices. Second, global diversification. A major company is not necessarily dependent on the British consumer. An S&P 500 company can sell into America, Europe, Asia, Latin America, the Middle East. Anywhere purchasing power exists. So wage stagnation in one domestic economy does not automatically destroy corporate revenue. Third, business-to-business spending. Corporations themselves are customers. And if corporate profits are capturing an increasing share of economic output, businesses possess capital that can be spent with other businesses. Enterprise software, cloud infrastructure, semiconductors, logistics, advertising, industrial equipment. The consumer is not the entire economy. And fourth, inelastic demand. There are certain things people simply cannot stop buying: food, energy, healthcare, basic services. When companies possess pricing power in essential sectors, consumers are forced to absorb higher prices even when wages fail to keep pace. And that is why corporate earnings can continue rising in an environment where the average worker feels progressively poorer. It sounds contradictory. It isn't. They are two sides of the same mechanism. Section 4. So what does the investor do? You change sides, not politically, not ideologically, economically. You stop allowing labor income to be your only claim on economic output and acquire ownership claims on capital. For a UK investor, that gives us two very different engines. The first is the growth engine. Global equities, held inside a stocks and shares ISA. Currency unhedged global equity ETFs, including funds tracking something like the S&P 500, give the investor exposure to corporations capable of repricing their goods and services as currencies depreciate. And inside the ISA structure, capital gains and dividends are sheltered from taxation. That matters enormously because now you have removed one of the principal frictions preventing compounding from doing its job. The company grows, the asset compounds, the currency depreciates, and the government does not continuously interrupt the process by taxing the nominal capital gain inside the ISA. That is the growth engine. But then you need something else, something that does not depend on corporate earnings, does not depend on management, does not depend on a bank, and does not require a digital intermediary. That brings us to the second engine, physical gold, specifically for the UK investor, gold sovereigns and Britannias. Because these coins are UK legal tender, they are exempt from capital gains tax. So now you have an asset that can track the underlying monetary debasement without creating the same CGT problem when you eventually dispose of it. No corporate counterparty, no earnings multiple, no banking dependency, no digital infrastructure required. It is the absolute preservation engine, and that distinction is important. Equities are designed to compound purchasing power. Gold is designed to preserve it. One is productive capital, the other is monetary insurance. Section 5. The investor's choice. And ultimately, this entire problem reduces to one uncomfortable reality. If you rely exclusively on wages while the currency is being systematically devalued, your standard of living is fighting a mathematical headwind. You can negotiate harder, work longer, earn more, save more. But if your savings remain trapped inside the depreciating monetary unit, you are running up an escalator that is moving down beneath you. The solution is not simply earn more currency. The solution is to acquire assets capable of repricing against the currency. Corporate equity gives you ownership of the pricing power. Physical gold gives you protection from the monetary unit itself. And the tax architecture determines how much of that protection you actually get to keep. That is the game. Labor earns the currency. Capital reprices against it. The state taxes the nominal illusion. And the investor's job is to understand the architecture well enough to stop standing on the wrong side of the transfer. Flint West signing off.